This brings us now to some unique or other methods that maybe aren't used as often, but I do want you to know about, and you've got some math based on them on your test guide. First up, we've got profitability index, and if the NPV is a dollar amount, the profitability is a ratio. This is, kind of like saying, comparing the NPV to net working capital and the profitability index to the current ratio, right? Now, in this case, the net present value is going to be a little bit better than the profitability index, but the profitability index could be used if you wanted to measure benefit per unit of cost. And it does include the time value money. And a good example that it's provided here is if you got a 1.1 PI, that's basically saying that for every dollar you put in, you expect to get a dollar 10 out, or 10% extra in value, right? And so, if you're trying to ration out your capital, this could be a useful tool. The main thing I want you to understand is that if that PI is greater than 1, you would accept. Now, that should tell you that when the PI is 1, the NPV is equal to 0, right? So if your IRR is equal to your required rate of return or your WACC or whatever, and your NPV is equal to 0, then your PI would be equal to 1. Okay? So that's something important to remember. I could see a conceptual question being asking about that on the exam, and if you're wanting to look, there's some conceptual questions on your test guide that'll cover that as well. But essentially what we're saying here is that you can put the present value in the numerator and the initial cost in the denominator, just like I'm showing you right here with this equation. Now, the major advantages for the profitability index is it mirrors the NPV and its value in some ways. It's going to consider all cash flows and the time value money. It's pretty easy to understand and communicate. Maybe a little bit more complicated than NPV, but that's probably because NPV is just better known. And it can be useful in capital rationing. Now, its biggest disadvantage is that it can conflict with the NPV about which project to choose. For example, if I'm comparing these two projects, let's figure out what the NPV and the PI are for both projects. Now, what I've really done here is given you a short and dirty kind of problem here. I told you what the initial cost is and what the present value of the cash flows are. Now, in this case, with project A, you're going to get a PI of 1.5, right? And the reason why it's going to be 1.5 times is because you're going to take that $15,000 over the $10,000. That's 1.5. If you're going to do that PI for project B, it would be 125 over 100, so that's 1.25. Now, based on those numbers, it would look like A would be the better choice. However, if you compare net present value, there's a lot more money involved in project B. Okay? And so sometimes scale can really hurt you when analyzing these projects. If you got to accept one of the two, you definitely would rather make $25,000 than $5,000, regardless of what the profitability index says. Okay. Now, if you had $125,000 to spend and you could get as many project A's as you wanted, or one project B, then you would probably go with project A. But that's not what they're saying here. You've got to choose between one of the two, so you always go with NPV. What about average accounting return? Well, what I want you to know is of all of the tools in your toolbox, this is probably the one I care the least about. One of the reasons is there's a whole lot of definitions for it, and also you got to make sure you understand what depreciation you're using, and I just don't think it's used that often. The basic decision criteria rule that you're going to use in here is that if this project has an average accounting return that's greater than the target rate, like the WACC or whatnot, then you would accept it. Okay? For example, say we have all of this data here. You've got year 0 cash flow negative 165, year 1 cash flow 63 120, year 2 70,800, year 3 91,080. Well, one of the things you're going to notice right now is if you go down and cheat and take a look at the math, you don't even use that cash flow data very much. You're going to use instead that number to the right, for the net income, because what you're going to do is take the average net income, put it in the numerator, and then you're going to take the average book value, which you may sometimes have to figure out, like in the math problems on your test guides using straight line depreciation, for the denominator. And then it's just a ratio. So it's the average net income over the average book value. And in this case, you're going to get 21.3%. That's less than 25%. So would we accept this project? No, we would not. So let's take a look at some decision criteria for the AR. Does the AR rule account for the time value money? Uh, no, not really. You're just looking at those cash flows. You're not really using the time value money in your calculations. Does the AR rule account for the risk of the cash flows? Sort of, depending on what that risk measurement, that required risk that your percentage you're comparing it to is based on. Yes. Does the AR rule provide an indication about the increase in value? Um, yes or no, depending on what you want to say is an increase in value. I mean, the rule is easy enough to follow, but it might be able to manipulate that rule in some ways, which gets to this last question. Should we consider the AR rule for our primary decision criteria? Absolutely not. Anytime you're dealing with this accounting type information, it can usually be skewed in one way to favor a certain company for a period of time or whatnot, and so not to say that anybody's cooking the books necessarily, but you could adjust or smooth out or play around with these numbers to the point where it might not give you a true value for a firm. In other words, a firm might end up accepting projects it shouldn't accept. So what then are the real advantages? Well, it's easy to calculate and you can usually find the information. I don't think that's enough because some of these others aren't too hard to calculate and you can find most of that information as well. So if I was to scratch one, it'd probably be the average accounting return of these tools, but it doesn't hurt to do it as well. Um, but once again, you're not really using a real rate of return. You're ignoring time value money. You're going to have some kind of arbitrary benchmark cutoff rate. Um, are you going to use the WACC or are you going to end up using just something you've made up? And based on accounting net income and book values, not cash flows and market values, which means you're looking at past information, not necessarily current information, or you may also be looking at information that could be manipulated. Finally, this brings us to probably the most used method after the NPV and the IRR and the MIR. You got the payback period. The payback period is really just a quick and dirty kind of rule of thumb or so. How do I know when I can get my money back? So it's the number of years required to recover a project's cost, or how long does it take to get my money back. Now, if you'll remember how we kind of went through the different marginal tax brackets, it's the same thing that we're going to do here with the payback period. Is we're going to keep going from one year to the next until we get all of our money back. Okay, we're just going to keep adding up projects' cash inflows until we get to the point where our cash flows for the project turns positive. And so that you could call this a rough kind of break-even type of measure. And so if you've got some kind of arbitrary rule, I need to be paid back within 3 years, and you're not, then don't accept it. If you are, then do accept it. So the decision rule is kind of a little weird here as well, if you ask me. Nonetheless, let's take a look at a problem. So let's look at Project L's payback calculation. You spend $100 right up the front. You see that in cash flow zero, so you need to get your $100 back. So you're going to get $10 back in year one. $60 back in year two, so you got $70 back. You need 30 more. You're going to end up getting your $30 back in that last year in year 80. So you know that you're basically going to need $30 of the $80 in year 80. So you're going to find a ratio there of 30 over 80, and so that's really 3/8, right? So you're going to have 2 3/8 or 2.375 years. If you want to go back and calculate it for Project S, you'll find it was 1.6 years. So you get your money back a lot quicker with Project S. And so if you're using the payback criteria, you're going to see that's going to favor projects that get paid back sooner. So what about the payback period and decision criteria? Well, it obviously is not looking at the time value of money. It doesn't even look at risk either. Um, you could say it's providing some kind of indication in value, but you're really looking more at a matter of time than you are at value. So it's pretty much asking the wrong question. And you can rank projects this way, but only if time is your most important variable. So would I consider it? I would absolutely not consider it as my main decision rule, but you could take it into consideration if you were in a specific industry where time was very important. Now, one way to get over this would be to use some of these flaws would be to use a discounted payback period. In particular, if you discount these future cash flows back using, some kind of a WACC or required rate of return or discount rate of some sort, then what you are doing is you're including the time value of money, right? So in this case, if you did that, then your payback period would be 2.7 years. So obviously, when you're discounting these future cash flows back, they're going to get smaller, so it's going to take you a little bit longer, and that's why the discounted payback was a little bit longer here than the regular payback. So what's the main thing here? Well, payback period is very easy to understand, and so you can do it sometimes in your head really fast. Uh, it does allow you to kind of skirt around the issue of uncertainty with some later cash flows because you probably won't have to include those in your calculation. But it's going to be very biased towards liquidity or short-term projects. So some of the disadvantages is it ignores the time value of money. It requires an arbitrary cutoff point. And in other words, who should decide at what point you quit caring about a project? So essentially, it's going to also then from that point on ignore future cash flows, which could be very substantial. You could have two projects that both pay you back in 2 years, but one of them keeps paying you back forever thereafter. That would be something to really consider. So it's going to be very biased against long-term projects, especially any kind of R&D projects or something that might take a while to get going. And I guess the big point here, like I said, is that it asks the wrong question. Okay? And I think that's so important that I kind of wrote that in just now. And it also, you've got this discounted payback that you can use, but it's only going to consider time value money. These other three major points here are still going to remain. So it's not as good, in my opinion, of a measure or method as NPV or IRR, but it is certainly one that you might hear about in the industry, and it could be one that could be fast and easy to kind of get your mind wrapped around how long it might take to recover your initial cost. Now, I brought up this last section here on multiple IRRs. I could have probably done this more with the MIRR section, because when you have multiple IRRs, you may have might have that usually happens from unconventional cash flows or something like that. So you might fix that with like the MIRR. But what I wanted to do here was get back to why we like NPV, and especially NIRR, and especially NPV over IRR. So let's take a look real quick at this last little thing on multiple IRRs for this lecture, and then we'll wrap up with a summary. So right away in this example, you can see that Project P has unconventional cash flows or non-normal cash flows. It's got a negative cash flow 0, which is what you'd expect, and then a positive cash flow $5,000, which is what you'd expect. But then it's got a negative $5,000 cash flow tied to the end. So if you put those cash flows in your calculator, you might get an IRR, but if you do, you don't know if it was the correct IRR or not. And I'll show you what I mean here. So you'd end up wanting to go with the NPV. And here's why. If you'll see, remember that an IRR happens anytime NPV equals 0. So in this case, you've got kind of a line that's crossing that NPV equals 0 in two places. So you've got multiple IRRs. Okay? And in one case, your IRR is 25%, and in another case, your IRR is 400%. That's a pretty big difference. So to get away from that confusion, I would just go with NPV. However, if you really like IRRs, then you can modify this with and go with modified internal rate of returns. Now, I included this slide right here for my mathaholics. If you are just really curious and you're a number geek like me and you want to know why there's multiple IRRs, here's some bullet points to think about. But I'm going to skip this slide for right now. So once again, the main point here is when there's non-normal or unconventional cash flows, you may get more than one IRR. So you'd want to use MIRR if you're determined to use IRRs. If you'll work this problem similar to the problem in your test guide, you will find out which approach they've used here to figure out the MIR. So I'll leave that for a little bit of a tease. Remember, you've got the discount approach, the reinvestment approach, and the combo approach. Now, as far as acceptance goes, you would not accept this project based on NPV because it's a negative amount. And if you look at your MIR, it's less than your WACC, so you obviously wouldn't accept it that way either. So now you've got a situation where your NPV and your MIR are in alignment. So once again, that would be how you would handle unconventional cash flows. And I'm glad that we brought that example back to kind of show the power of NPV there. So let's wrap this up with a summary. Now, capital budgeting in practice is really going to consider all of these tools, but remember, NPV is going to be the trump card. It does matter quite a bit about the mission and vision for a company, and sometimes if your numbers are close enough, but you really feel one's putting you like philosophically shifting your company away from your core competencies or what you're good at, then maybe you don't go with it, right? So we're just here analyzing the numbers right now, but there could be some other criteria to look at as well, and some situations in which you might favor one of these tools over the other. Once again, NPV and IRR are the most commonly favored, but payback is often used quite a bit as well. And all of these tools will give you some valuable information, although I think I could argue maybe against the average accounting return. So let's take a look at all of the major 5-1. So you probably want to ask yourself, what am I looking for? Well, if I'm looking for a dollar amount or like a dollar increase in the value for the firm, I would go with NPV. And I think a lot of shareholders are interested in that. Now, some people may worry about liquidity, want to know how soon they're going to get paid back, so they're looking for a measure of time, usually like years, but sometimes maybe even shorter than that, months or whatnot. You could do paybacks in days if you wanted to. Average accounting return is going to give you a percentage. However, I would think that the IRR is far more valuable than the average accounting return. And so I would say it would definitely trump that. And then you've got this one ratio here, which is the profitability index. And I would say this would be really important if you're trying to boil down, your project to how much profit are you making per investment, right? So profit over cost. Once again, net present value, difference between present value of inflows and the initial cost. You'll always accept it if the NPV is greater than zero. It doesn't have a whole lot of serious flaws, and that's one of the reasons. In fact, it really doesn't have any major ones. The only flaw I could maybe give it is that it gives it to you in dollar amount instead of a percentage, which sometimes can be somewhat skew your view on certain projects. But it's that's one of the main reasons it's the preferred decision tool method, is because it is doesn't have any major flaws. The IRR is definitely got the silver medal in this competition. But if you could modify it, you could give it a running for maybe the gold medal. However, there's some more work involved in that. And there's some other reasons perhaps that you would still want to go with NPV, because some of the assumptions you use to get the MIR, you could argue, are as good as the assumptions that are used to get the NPV. But remember that the IRR is the discount rate that makes the NPV equal to 0, or you could say makes the profitability index equal to 1. So remember that for your exam. You're going to obviously accept any project that when the IRR is greater than the required return, and that makes sense because the required return is what you need and the IRR is what you're going to get. So if what you're going to get is greater than what you need, then bingo, you take it, right? Usually it's going to be the same decision as the NPV unless there are unconventional cash flows or you're dealing with mutually exclusive projects. And remember, with a case of unconventional cash flows, you can definitely use the MIRR. Profitability index, remember, is just going to measure profit over cost, all right? So this benefit cost ratio here, you're going to accept it if the profitability index is greater than 1. It's usually going to be the same as the NPV as far as an acceptance, but sometimes if you got projects of differing scale, you can get yourself in a situation where they do conflict. And if you have to accept one or the other and that's it, then you definitely still want to go with NPV. All right, once again with average accounting return, I'm not a big fan, but here you're looking for average net income over average book value. So if that average or if that average accounting return is greater than your WACC or some other crazy specified target that they've created, then you would go with it, right? The data here is usually easily found. However, you're not really dealing with a true rate of return. Time value money is obviously ignored here. You've got kind of an arbitrary benchmark that you're looking at as far as what this specified target is. And it's also based on accounting data instead of market data, which means that you're looking at past information or perhaps information that could be easily or more easily manipulated. Finally, we get to the payback period. This is our last slide for this lecture. It's really just the length of the time until you get your money back. If you get it back within the time that you want to get it back, then you'd accept the project. It's not going to though account for any time value money. That who's to say when that cutoff point should be, and what why are you not valuing anything that happens after that project? Once again, I might give everybody in the class the choice between me giving them $1 every day for the next week or $1 every day for the rest of their life. Obviously, the dollar every day for the rest of their life would be better, but if you only had to pay $5 to get this deal, then from a payback standpoint, you're going to look at both of those equally, whereas one of them is worth far more, right? The one where you're going to get the buck for forever. Okay. So in the end, it really just asks the wrong question. It's asking about time instead of about value. Okay. As far as value, I hope you found lecture 5.1 valuable. This concludes the lecture, and if you have any questions, please let me know.